Dear investor, in this piece, let us discuss the following. 1. Market may be bottoming out. 2. It continues to be time for alpha. 3rd, high active weights in our portfolio. 4th, sectoral thoughts. And 5th, conclusion. Now, coming period may present a good outlook for the markets with flows overall expected to improve along with sentiment and supply of paper reducing on the margin. Let us consider the following. 1. Gold prices are now stagnating and flows into that asset class may diminish. Gold price rise in the past period has been relentless and has induced a lot of passive flows into the metal. More recently, even silver joined the trend. However, gold and silver are now undergoing a phase of consolidation close to the top. This category got 15,000 crores of flows in October. Most investors are still making a lot of money and the wealth effect may sustain, which is positive, but consolidation in gold may be beneficial for regular active equity as it will be able to target a larger pie of flows. Now, supply of paper in the primary market has peaked out for the time being, leaving more for the secondary market, leaving more flows for the secondary market. Now, till October, the intensity of fundraise from the Indian market was very strong. It absorbed liquidity in the MFs at the beginning of the year and is forcing a sale of held portfolio stocks to subscribe to the newer offers. This has put some pressure on the secondary markets. However, the money raised from primary markets may have reached a near-term peak. It may be a few months before the October peak is crossed. This leaves incrementally more money potentially for the secondary markets. Now, the experience in most large issues where retail interest was high has been positive. IPOs are often the path that investors take to come to the market. We do expect to see an increase in number of investors with demat account in the month of October. Most of these investors have had a good start to their investing journey and could deepen their commitment to the equity asset class. This helps broaden and deepen the equity cult in the country. Net domestic flows have also diminished in October but may pick up as more intense fund demand in festive season is now behind. India had a strong festive season real economic demand and that this could be a reason to see large redemptions experienced by the industry in the month of October. PI sales is lower on better relative valuations and stable INR. In the global context, Indian markets have been laggards for the last 1 year. This has resulted in a sharp correction in relative valuation. Logically, with lower yields in the US, Fed having cut rates and again expanding balance sheet should start to happen soon and improved relative valuation, the overall construct suggests a potential reduction in FPI sales. We continue to expect negative sales though because of an unfavorable outlook on many BRIC countries in the developed world. The EM fund bucket should hence be seen as a leaking bucket with money moving from one market to the other being the pattern. Sentiment, the other big factor, is expected to improve as focused on culmination of the India-US trade development progresses. Most markets have performed well after the trade agreement with the US and India could follow a similar path. In any case, with profit expansion over past year and income tax cut in the last budget, GST cuts recently, RBI cutting repo rates and more cuts expected over the next period, there is significant spring energy in the price. Lower inflation, low crude prices and good Q3 outlook are supportive for sentiment. Rate cuts may lower the threshold of investors to move to equity. Now, this phenomenon was seen during COVID-19 when the demat expansion gained momentum when repo rate dropped to 4%. With expectations of a further cut over the next few months, repo rate could move lower a level which could support increased interest into equity. Now, on the caution side, weak Jan to March 15 period should be kept in mind. This year, we experienced a large cut. We had shared that this phenomenon has happened 11 out of 16 years, with 9 out of these years seeing a reversal over rest of the year. This year appears to have followed a similar trend. Next year could be gentler as INR may stabilize after a sharp depreciation. It's happened already. Q3 results is expected to benefit from GST cuts and good monsoons and budget could be friendlier towards investors given the current market conditions. The period could also see potential benefits from culmination of the trade deal. Now, coming down to the next section, it continues to be time for alpha. The Q2 FY26 corporate earnings concluded on a healthy note with overall earnings trend driven by OMCs, telecom, metals, technology, NBFCs on the lending side, cement and capital goods. Conversely, oil and gas, ex-OMCs, automobiles led by one or two names, and banks, both private and PSU, dragged overall profitability. Nifty delivered a 2% YOY PAT growth. It delivered a single-digit earnings growth for the 6th consecutive quarter since the pandemic. That is Nifty specific. Large caps delivered 10% growth. Mid performed relatively better, while the growth in small caps was narrow. This quarter saw number of companies delivering higher than expected earnings growth exceed number of companies that did not. So this was a change in trend. This season has again witnessed a sharp deviation in performance of the new emerging spaces versus the spaces reflected in the index, and the table below showcases the same. We believe that markets generally follow earnings growth adjusted for valuations. With this thought, we aim to include sustained high growth spaces of the market in our portfolios, building a construct focus on high earnings growth potential. Over the past few years, it has been seen that the market share of the top 10 names in the index has declined, reflecting increasing market recognition of evolving realities. Now, our markets hence are high on active ratios. At MO, we practice focused high conviction investing and construct portfolios which have a high active ratio. This approach aims to identify opportunities in spaces with potential for sustained earnings growth, as we believe that markets generally follow earnings adjusted for valuations. The present period shows several spaces evident in quarterly results which are offering the combo of relatively high growth with the potential to sustain it over a period of time. These spaces find prominence in our constructs compared to traditional spaces, which are more represented in the indices and typically show lower comparatively earnings growth. Some sectoral thoughts. Now, banks saw relatively positive stock performance in October, while many banks delivered a NIM decline. As past rate cuts were transmitted, some reported flat to better NIMs also. There is a thought that NIMs may have bottomed out. This resulted in improved sentiment towards bank. The sentiment was also supported by PSU consolidation reports and higher FPI limits for PSUs, which could potentially increase passive flows. While technical factors continue to play out, lower inflation may create conditions for regulated rate cuts over the next few months. Banks have achieved the NIM sustenance by reducing savings bank rate, in many cases notably. Some large banks have savings rate at around 2.5%, a sharp cut from historical levels of 4%. This lever may be drying out. Further, RBI rate cuts could have a deeper impact on NIMs. We have some exposure to mid-cap names where growth potential is high, and select PSU banks which could benefit from any index-related passive moves. IT, the other large sector, also did well in the past period, while earnings growth was sub 10%. The stock price moves for most names in IT have generally reflected profit changes. Our funds are focused on high growth in earning spaces. Our outperformance versus indices over last 1 year has been modest. This points to substantial valuation correction for the high earnings growth part of the market, while the earnings growth potential may continue to sustain. Conclusion. With sentiment improving and with policy environment increasingly becoming pro-equity and demand supply of paper is also incrementally favoring the secondary markets, we think there is potential for improved market performance in the next period. With high growth spaces continuing to deliver good growth, we think there is potential for alpha, especially with strong valuation correction on relative basis over the past 1 year. Lower inflation, better liquidity in India and globally, lower interest rates are all supportive factors for growth investing, and could help our cause. Our portfolios remain highly domestic focused, are low on leverage, and are less exposed to spaces like commodities, staples, oil, coal, cement, large IT, and large banks on account of lower growth outlook in these spaces or higher volatility in earnings. Thank you. Happy investing. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.